Thanks for joining us. John, Nick, Jack, and I, and the whole team here at Centennial Wealth Advisory and Retiring Well are excited to have you this week. We got some wonderful topics lined up for you, and we hope you can sit back and enjoy them. First, we're going to dive into trust. What is that, and maybe how does that relate to your overall plan? Then, going to dive into systematic risk. There's various different risks that you have as an investor, and this is just one of them, but a little bit of a deeper dive of what that is and what does that mean to you. How about tax bracket optimization? Boy, kind of a funky term there, and obviously everybody hears taxes, their ears perk up, but what do these specific brackets have to do, and maybe how do you optimize that? And finally, when looking at how do we pay less on retirement account withdrawals. When you go to start taking money out of these pre-tax accounts, there's going to be some tax consequences, some tips for potentially lowering that hit.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well. Plan to retire well.
Trust. This is vital in any relationship, and the best definition of trust that I've heard is consistency over time. And one thing with that is you can't shortcut time. So if you're in an area where you're looking to maybe start a new relationship with a financial advisor, then you don't necessarily have that time behind you to help build that long-term trust. So, you know, we've been airing this Retiring Well TV show here in Northern Michigan for the past 11 years. So maybe you've seen the show and maybe gotten a feel for how we approach things, but again, it's one where maybe we haven't had the opportunity yet to sit down and just have a conversation and start building that trust and that long-term relationship. So it's important from our perspective that your advisor's working with a third-party custodian where they're holding the assets. The money isn't held there at that local firm. I mean, that's ultimately when you think back to the Bernie Madoff, they were essentially keeping the money, creating false reports and everything. So you want to have a reputable third-party custodian to work with. You know, referrals from family, friends might be a way to start that process where they've been working maybe with an advisor for a long period of time and have built that trust. That might make it an easier transition. What about looking into, there's different background checks that you can do on financial advisors, whether that's through FINRA, F-I-N-R-A. FINRA is one source for brokerage check. You can also look up different insurance licensing through the state of Michigan or whatever state you might be in, and so those are ways to learn a little bit more. Company disclosures, those are updated regularly and typically may be posted on their website and can report any conflicts of interest that might be out there. From our perspective, an advisor should clearly lay out for you and be transparent with what the fees are on a different account or how the advisor is paid. That's important to better understand for you how that relationship's going to work. I think it's important to talk about the bad times in the market. You know, somebody could present to you all those great times and the big returns, but more importantly, what does that look like in retirement when there's different bad times that are going to occur in the market? What can you expect? What was 2008 as an example? What did that look like? Communication is another piece that we typically will hear from folks that come to us where maybe they haven't heard from their advisor regularly. So this is something I know for us, we try and do quarterly market updates to continue to stay in communication. What about in education on different investments or strategies? It's important to be involved with your money and what they're doing. What about, are they independent or do they just work with one company's products? All of these different areas are vital to know, and we encourage you, if you have questions, please give us a call.
What a powerful topic there on trust. It's just so important to be able to trust who's giving you that financial advice. And you know, through the years, the best definition of trust that I've ever come across is trust equals consistency over time. And you're probably thinking, well, if I haven't met with you yet, I haven't had much time with you, not enough time to be consistent. How do I possibly trust you, right? We do this TV show week in and week out for you guys to get that information from us. But also, when you meet with us that first time, what's going to be unique is that we're not going to push anything on you or expect you to join Centennial Wealth right then and there, okay? Typically, it takes a number of meetings. We want to get to know you first as well. We want to know if you're a fit for us too. And that's where multiple different meetings come into play. We get to see what each other's doing, how we go about the process and so forth, and then you can make that decision for yourself. There's no time frame. I mean, it could take a couple meetings, it could take a number of meetings, but what we want to do is make sure that we establish that trust for both of us.
And I also like what Nick said there, where this is a team event, and what we get to do is kind of set that expectation from really the first time that we meet. You know, what we're looking for is, can we really add value to this client? You're sitting there, can I trust them? Can we add value? If that's a win-win, we can proceed and move forward. And if it's not, then we really hope that you learned something through that first meeting process, because we have our whiteboard, we have our TV, we have multiple different resources to teach from day one. The other thing I'd like to say about trust is I actually learned it from a local business leader. He has hired a lot of people for many, many, many years. And we were serving on council together at church, and we had to do some hiring. And so we went through all the different interview processes that we had lined up. And as in our little meeting, just the people that were going to do the hiring, he just looked at us and he says, hey, what's your gut? What's your gut feeling? And that was powerful to me, because I thought, you know what, he's right. You should be able to trust your gut. Take in a whole lot of data, do some research, trust your gut. So I hope that's helpful. Coming up next, we're going to be talking about systemic risk and tax bracket optimization. You do not want to miss it.
If you are retired or soon to be retired, let us help you plan to retire well. Centennial Wealth Advisory specializes in retirement planning and has offices in Traverse City, Cadillac, Petoskey, and Gaylord. We'll never pressure anyone to become a client. Our goal is to inform and educate. Simply attend one of our live events or schedule a meeting at one of our Northern Michigan office locations for a free, no obligation retirement review.
Financial planning is more than just providing for yourself. It's making sure your loved ones are taken care of. It's preserving and protecting what you've worked for all those years. It's leaving a legacy to your children and grandchildren. It's providing a level of stability and security. Planning is the first step to succeeding. Plan to retire well.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
There's all kinds of different risks that are obviously going to be out there when you look at the investment world. One that let's focus on right now, systematic risk. So this effectively is kind of the inherent risk that the market has, okay? This can come from economic, geopolitical, other unpredictable, sometimes impossible to avoid in some circumstances. The old saying, all ships rise and fall with the tide, right? So with systematic risk is kind of that idea that if you're in a certain market thing, even though maybe the specific investment or stock or whatever it may be is not directly impacted by that, it's going to feel that risk of the environment around it, okay? So let me give you an example of potentially what this may look like. The S&P 500, you're invested in an S&P 500 index fund. Well, effectively, you would expect that to basically benchmark the S&P 500, right? So as that goes up and down, your fund should relatively perform very similar, okay? The S&P 500 is composed of large company stocks. Well, let's say you had a large company ETF or mutual fund. Well, obviously, if the S&P is going to move around based on economic factors, geopolitical stuff, your large cap fund is probably going to move some of that. Even though potentially inside of that, you have some individual holdings or something like that that are doing very well, all the other stuff is going to move with that systematic risk. So when you look at this, once again, sometimes they say it's unavoidable. But when you look at stuff as how to properly position a portfolio, depending upon the stage of life you're in, whether you're in the growth and accumulation or preservation of wealth and distribution, you want to look at diversification. And I'm just not talking about different stocks, different bonds, all that sort of stuff. Sometimes you kind of have to look outside the box if you're truly trying to get away from systematic risk. You know, sometimes with these geopolitical things or different things, you can see the markets moving in kind of big swings, and it's, well, why is that company going down? Their earnings just come out and it was good. Well, that's that influence that the macro environment has on those things. So when you look at building that portfolio, there's more to it than just picking different things or picking different funds in a lot of cases. You have to consider how these other things match up. And once again, this is where we talked about is getting a second opinion. As you enter maybe these few years leading up to retirement or you're in retirement, the game's changed a little bit here. And want to make sure that you have things goal-oriented, matched up with what you're trying to do, so you have the best chance of success over time. We don't want to see a situation where you're running out of money prior to your passing. Most people, that's their biggest fear of their life. So give us a call. We'd love to talk with you a little further and see if there's anything we can do to be of help with you and help educate you on retirement planning.
At Centennial Wealth Advisory, we take a holistic approach to your retirement planning. So it's not just looking at what your investments are, but what is that long-term income plan for the next 30, 40 years of your retirement? What about taxes and what role they play in your retirement plan? Estate planning, what about life insurance, health insurance planning, all key areas to consider when looking at your retirement. So please visit our website or call the number on the screen. We'd love the opportunity to sit down with you for a no-cost, no-obligation visit.
When you have confidence in your retirement future, you can live the life you've always imagined. Because of planning, you now have time to reflect on the wonderful memories of your life. You and your spouse finally have the luxury of leisure time together. To spend fun times with your grandkids, sharing the joy of their excitement about life. Smiling at the thought of quality time with your children and of picking up the check. At last, you have time to breathe and rekindle the love of your life. Why? Because you imagined what could be. You planned for retirement. So today, you own your future.
So what does it mean to optimize your tax bracket? So first, it's important to understand that different tax brackets exist, and as you hit the next bracket, only the portion in that bracket is going to be taxed at the higher rate, not all of your money. So the next thing to keep in mind is that tax brackets are based on your taxable income. So you're going to have your gross income, and then you're going to subtract either the standard deduction, or if you're in a place where maybe you have larger charitable givings or mortgage interest, and maybe you're itemizing your deductions. But ultimately you're taking your gross income minus those deductions to get to a taxable income amount. When you read what those different brackets are, it's based on that. So let's imagine in this case that you're married, filing jointly, and so approximately the first $20,000 or so is taxed at a 10% rate, and then between $20,000 to $81,000 you're going to be taxed at a 12% rate. So for illustrative purposes, we'll assume you have a taxable income of $60,000. So that's going to be approximately $86,000 of gross income if you're taking the standard deduction. So here you sit at say $61,000 or so of taxable income, and the top of the 12% bracket is $81,000. So you have room of maybe $20,000 in that 12% bracket. So maybe you want to consider withdrawing $20,000 from your 401k or IRA, or if you don't need the funds, maybe it's time where you start looking at doing Roth conversions and starting to build some tax-free assets. Or what if you've now surpassed that 12% bracket and now you're into that next bracket, which is 22%, and based on your, maybe you have a pension, Social Security, other income, and you're most likely going to stay in that higher bracket, or maybe it's even higher over time, then maybe again it's a time where you want to be considering, does it make sense to accelerate money coming out of those taxable accounts and shifting over either to tax-free or after-tax assets that then you would have future access to. So, and that's one where, not sure how you feel about things, but it's one where the long-term projections, as we're in a lower tax environment today, is that there's the potential for those tax rates to go up in the future. At the current time, assuming nothing were to change, the current tax rates are supposed to be in place through 2025. So again, taxes are a vital piece of your overall retirement plan, and unfortunately a lot of times people are strictly relying on their accountant to help them with that, but the accountant may just be looking at that 1 year, not looking at future planning. So again, here at Centennial Wealth Advisory, that's part of what we do year in and year out, and we'd encourage you to give us a call and help you plan to retire well.
Hey, welcome back. I think those are some of the most important topics that you should be learning about right now. Recently in the Cadillac office, I came across a person who came in and they showed me their 401k, and before I even looked at how it was invested, I just said, hey, what are some of your goals? They said, well, I'm 61 years old, my wife is 62, she just started Social Security, I'm still working probably for a few more years until I turn 65. I have this 401k, I have the option to do an in-service rollover and still participate with the plan. We're just curious if you might have some other ideas for our investments. And I said, okay, well, before we get into that, let's talk about some goals. What do you think of the systemic risk of the market, or what do you think of the risk and volatility of the market? You know, what kind of investor are you over these next few years? And they basically said, we just want to protect what we have. And I said, okay, no problem. There's different products out there that can, serve a great purpose doing that. So we looked at the statements, and they were in 85% was aggressive growth, and then 15% were in growth strategies, two different in their 401k. It was something that had started a long time ago, and roughly over the last 10 years, the markets have done great. But in the current environment with the current goals, that did not match up. We were able to look through their statement with a fine-tuned comb, explain what they had, and they understood quickly that some changes were in order because of what they were trying to achieve. So, yep.
Yeah, another topic that was discussed there was tax bracket optimization. Here at Centennial Wealth, not only do we do investment planning, but we do tax planning as well, and that's a huge part of our business. As far as tax bracket optimization goes, it's just just important to know your numbers, like we've said before. Where does your income fall, and what tax bracket are you in? And if you have room in whatever current tax bracket you're in to convert from IRA to Roth money, why wouldn't you do it, right? The tax law that we're currently in sunsets in 2025. The 12% bracket that we currently have used to be at 15%. The 22 used to be at 25%. So why wouldn't you want to buy out Uncle Sam now to save a few cents on the dollar by doing it now? But it's important to know your numbers, right? All right, I hope you found that valuable. Stay tuned. We're going to be talking about how to pay less in taxes with those retirement account withdrawals. You don't want to miss it.
Living life isn't always easy. It puts up challenges and obstacles you'll have to overcome. There are responsibilities. You put in effort to provide and take care of your family, and to save and invest, to balance work and life. Planning is the first step to succeeding. Plan to retire well.
You made it. Years of hard work, investing, planning, and now you're here. The long-awaited reward you spent a lifetime looking forward to. But what now? After years of growing a nest egg, now you may want to manage it. Use it to fund your dreams. Make it last as long as you need it, and leave some for those you love. So what do? Wall Street continues to be uncertain, and some conservative options have dropped through the floor. How do you maintain opportunities for growth and reduce risk of loss from market changes? That's where we come in. We are financial professionals. From investments and insurance products to tax reduction strategies and guaranteed retirement income you cannot outlive, provided by the claims-paying ability of insurance companies. You've worked a lifetime to get here. Let us help you enjoy it to the fullest. For a complimentary consultation, simply contact us today.
As we're nearing the end of the show here, I'm going to say a topic that I'm sure your ears will perk up a little bit on. How to pay less tax on retirement account withdrawals, right? The less tax got your attention, I'm sure. But start off with some bad news. If you have a 401k, pre-tax IRA, traditional IRA, that sort of stuff where you haven't paid tax yet, guess what? Account's not all yours, right? When you look at that balance that you've worked hard and accumulated for, likely there's a portion that Uncle Sam wants to get a piece of, right? So let's talk about ways that potentially, not for everybody, not everything is going to be specific to you in this, potentially this could impact you in a positive way. Number one, avoid early withdrawal penalties. So traditional IRAs, 59.5, you can take money out after that. If you take it out before, in most circumstances, there's some different rules that may qualify for it, but in most circumstances, you're going to pay an early withdrawal penalty if you take it out before 59.5. That's an extra 10% hit that you're going to have to pay plus whatever tax bracket you're in. So tip number one, try to avoid that if you can. There's certain ways around that, or just try not doing it or getting funds from somewhere else, right? Second thing, if you're changing jobs, retiring, or doing any sort of rollover, make sure it's done properly. You know, there's different ways when you do these things that it could cause a taxable event if you do it improperly. So even though the intentions may be good, you want to make sure if you're doing that sort of stuff and rolling money into different accounts, another 401k at a new employer, your IRA, or with a financial advisor, or something like that, make sure it's being done properly so it's a non-taxable event and you're not having to pay that income tax as a surprise in that environment. The other thing, now let's fast forward later into retirement for a lot of people, required minimum distributions. At the age of 72, you're required to take a certain percentage of those traditional IRAs or 401ks out. If you miss that and you have to pay the penalty, it's a 50% tax penalty. Pretty big hit that you can avoid just by simply making sure you're planning and staying on top of that. The other thing that kind of coincides with required minimum distributions, if you're someone that's tithing to your church, making gifts to nonprofits, stuff like that, charitable organizations, consider using qualified charitable distributions, QCDs. Consider using those. It may give you a tax advantage, and depending upon your tax situation, it could make that a very beneficial gift to you and obviously the nonprofit you may be working with. Finally, consider Roth contributions or conversions depending upon your situation. Remember, Roth distributions are tax-free for most folks, potentially could better your tax situation. Have a tax plan pre-retirement and in retirement. It could make all the difference in your retirement and save you hundreds, if not thousands, in potential situations.
Hey, welcome back. I'm so glad that you join us each and every week. You get to help lead your life by learning. Sit on your couch or have some coffee, and I really do hope that we add value to your learning. I have a couple personal stories about some situations that I've run across in the Cadillac office. One, there was a client very young and has become very successful and wanted to know how to handle some of those responsibilities of success. And I asked them, I said, do you understand, or have you ever heard of the phrase called FIRE, the acronym? And they said, no. I said, okay, it's called Financial Independence, Retire Early. You're in a FIRE situation. Your goal is to retire at 40. Okay. Well, he's on track to retire at 40. So his plan is to take 72T systematic withdrawals from his IRA starting at age 40. He's going to avoid a 10% early withdrawal because of that. The other situation that I had out of the Cadillac office was somebody, they were 72 years old. They were tithing to their church, and they came in and they said, hey, I got this RMD I have to take. And so I was able to teach them. I'm like, well, if you are tithing to that charity, why don't we just send your RMD directly to it, do a qualified charitable distribution. It's a win for the charity in your church. It's a win for you because it doesn't show up for tax purposes as far as a taxable gain, taxable distribution, rather. And knowing stuff is helpful, and they were thrilled that they could do that and pay less on taxes in their retirement withdrawals.
Yeah, I have a similar story too out of the Petoskey office where a couple came in and they were only 57 years old, and they really wanted to know how to avoid that 10% withdrawal penalty. They had money in their 401k and they wanted to roll it over to an IRA and have somebody manage it for them because they weren't really satisfied with the different options in their 401k. And so what we did is we determined that we needed to leave about 3.5 years of income back in that 401k so that they would avoid that 10% penalty, but then we could roll the rest of their funds over to an IRA and have the entire investment world open to them at that point. So hopefully by watching the show you've learned there's lots of different options out there to avoid penalties and avoid higher taxes, okay? So again, if you want more information, please check out our website, go to YouTube/Retiring Well, lots of different episodes on there to gather so much more information. All right, we'll see you next week. Same time, same station.